This is episode 3 of the How the Dollar Actually Works trilogy, the FDIC lie. The FDIC says $22.6 trillion in American bank deposits are insured. Your checking account, your savings, your business payroll. You see the little logo on the branch door in the app screen. Each depositor insured up to $250,000. That sounds absolute. It sounds like a seatbelt. It sounds like certainty. But the FDIC insurance fund that backs this promise currently holds around $128 billion. That's it, $128 billion for $22.6 trillion. If you do the math, that's coverage for less than 0.6% of deposits. Deposit insurance is built to cover a few scattered bank fires, not the whole neighborhood burning at once. Imagine an insurer that promises to rebuild every house on your street, but only keeps enough cash on hand to rebuild one. As long as only one house catches fire every few years, they look like heroes. If the whole block goes up, the promise dies instantly. The system does the same thing with your bank account. And this isn't a thought experiment. We've already seen what happens when that math meets a real crisis. In America, Japan, Europe, and again in the United States. Deposit insurance was invented for a real problem. Before the FDIC, bank runs were brutal and frequent. One rumor, one bad headline, and people lined up around the block. If you weren't early, you lost everything. So the idea was simple. Pool premiums from many banks into a fund that can make depositors whole when a few banks fail. It's like every building on a street paying into a shared fire fund. If one shop burns down, everyone chips in and the owner gets rebuilt. Each insured bank pays a small premium into the fund. That fund builds up a cushion of reserves. When a bank fails, the fund steps in. It takes over the failed bank's assets, pays out insured depositors, and sells what it can recover. In normal times, when failures are rare and scattered, this works. A badly managed bank here, a fraud there, a regional recession somewhere else. The premiums from the many quietly cover the losses from the few. That's why deposit insurance survived for decades without obvious drama. It looked like a miracle. No more old school bank runs, but no visible cost to you. The problem only shows up when the failures stop being rare and scattered and start being systemic. See the mechanism, strip away the logos and acronyms? You have thousands of banks taking deposits and making loans. One insurer with a small fund of cash and liquid assets. A promise. Up to $250,000 per depositor, per bank, will be paid in full. The insurer is structurally tiny compared to the system it guarantees. It's a dam that can handle a few leaks in the wall, not a tsunami. The fund's size is set politically, not mathematically. Lawmakers pick a target reserve ratio, often around 2% of insured deposits. Banks lobby to keep premiums low. Politicians like the appearance of safety without the pain of higher fees. Over time, the fund hovers at numbers like 0.6%, 1%, maybe 1.2% of deposits. In good times, this seems enough. A few banks fail, the fund pays out. It rebuilds through new premiums. Everyone points at the logo and says, "See, it works." But crises don't arrive like random lightning strikes. They arrive like storms. Many banks with similar exposures making the same mistakes at the same time. The fund is designed for idiosyncratic failures. Crises are correlated failures. Imagine 1,000 banks, each with $1 billion in insured deposits. Total insured deposits, $1 trillion. The insurance fund holds 1%, or $10 billion. If, over 20 years, 50 banks fail one by one, the fund can cover them. It collects premiums, sells assets, and smooths out the losses. If in one crisis, 150 banks fail together with big losses, the claims arrive at once. The fund is immediately too small. Deposit insurance can handle failure number 1, or 5, or 10. It cannot handle failure 101 in a 100 bank capacity system. At that moment, the guarantee stops being a contract and becomes a political decision. Who gets paid in full? Who waits? Who takes a cut? How much can the government afford to socialize, and who eats the rest? You see the real system when the fund hits zero. We've already seen it more than once. America's savings and loan crisis, late 1980s. The U.S. savings and loan industry has $1 trillion in deposits insured by a fund with $6.3 billion in reserves, about 0.6% coverage. Interest rates spike. Thrifts are stuck with long, low-rate mortgages funded by short, now high-rate deposits. They bleed cash. Hundreds fail in a short window. Losses blow through the insurance fund almost immediately. The supposed backstop is too small by an order of magnitude. Taxpayers end up covering around $132 billion to resolve over 1,000 failed institutions. That $132 billion didn't vanish. It came out of taxes. Ordinary workers paid for deposit insurance that didn't actually exist. The guarantee holds, but only because the government quietly moves the bill to the public. Japan's lost decade, 1990s Japan. The Deposit Insurance Corporation backs roughly 600 trillion yen in deposits with about 6 trillion yen in reserves. Again, roughly 1% coverage. A gigantic property bubble pops. Real estate values fall by 70%. Bad loans appear everywhere at once. The insurance fund is instantly overwhelmed. To keep the system from imploding, the government injects more than 12 trillion yen of public money into the banks. The fund works only because the state steps in, debts explode, and the economy flatlines for a decade. Cyprus. When the fund truly dies, 2013, Cyprus. Foreign money has flooded in. The banks are huge relative to the economy. The deposit guarantee covers about 100,000 euros per depositor, on paper insured. In practice, the fund holds around 0.2% of deposits. When the banks fail together, the numbers don't even pretend to work. Banks close for days, ATMs are rationed, capital controls lock money inside the country. Large deposits are bailed in. Up to 47.5% of balances above 100,000 euros are converted into bank equity or simply written off. For the first time in modern history, a government openly admitted that deposit insurance was fiction when the numbers got big enough. If you think this only happens in small, faraway economies, Cyprus had ATMs, smartphones, and the same insured stickers you walk past every week. Same pattern, 3 different places. Tiny fund, systemic shock, fund dies, politics decides who is saved, who pays, and how much. Here's what's worth noting about the timeline. The S and L crisis took about 7 years to fully collapse. Japan's crisis took 6. Cyprus went from trigger to deposit seizure in 3 years. The collapses are speeding up. Then Silicon Valley Bank collapsed in 72 hours. Now come back to the FDIC's shield on your bank door. It currently backs roughly $22.6 trillion in deposits across about 4,600 institutions. The Deposit Insurance Fund holds around $128 billion. That's about 0.57% coverage, worse than US thrifts before the S&L crisis, and worse than Japan before its banking collapse. The FDIC's own reserve ratio has slipped below the target it set for itself. By its own standards, it is underfunded. Meanwhile, look at the stresses piling up in the system. Commercial real estate loans in the trillions, backed by half-empty offices, and repriced debt. Hundreds of billions in unrealized losses on bank securities from the rate shock. Hundreds of billions in deposits already leaving smaller banks for money market funds and larger institutions. A modern banking app that lets billions move at the speed of a push notification. We saw a preview in March 2023. Silicon Valley Bank went from fine to failure in roughly 48 hours. Depositors yanked tens of billions by phone and laptop. Signature and First Republic followed. Bank runs now happen at Wi-Fi speed. The claims can arrive in days, not months. The FDIC can handle one Silicon Valley bank at a time. It cannot arithmetically handle many SVBs at once. The dam can manage a few cracks in the wall. A coordinated wave over the top sweeps it away. A cluster of regional banks with similar exposures runs into trouble together. Deposits race toward too big to fail institutions and money funds. The FDIC resolves multiple failures in a compressed time window. The fund shrinks rapidly. Confidence fractures. At a certain scale, Treasury and the Fed must choose print, tax, or haircut. And remember, over $8 trillion of deposits sit above the $250,000 insurance cap. Those are the balances most likely to sprint first in a panic, and the balances most likely to be negotiated in any rescue. This isn't just about banks. If you run payroll from a business account, this is whether your employees get paid the Monday after a failure. If your life-saving site earning 0.5% in a big bank, you are funding this structure on the worst possible terms. The logo says insured. The arithmetic says conditional. Here's the entire mechanism in plain language. We pool small fees from thousands of banks into a common fund. That fund is kept at a politically comfortable size, tiny relative to total deposits. In quiet times, when a few banks fail here and there, the fund works. It pays depositors, rebuilds slowly, and looks trustworthy. Over years, the existence of the guarantee encourages more risk. Banks stretch further. Politicians avoid hard choices. Depositors stop paying attention to balance sheets. Then a systemic shock hits. Many banks with similar exposures take losses at the same time. Claims hit the insurance fund in a wave. The fund is too small, it empties quickly. At that point, the guarantee turns into a political choice. Print money, tax broadly, or seize and haircut some deposits to recapitalize the system. That sequence isn't opinion. It's design plus arithmetic. If you live on a salary and store your savings in dollars, you sit inside this machine. Your checking account balance is not just your money, it is part of the liability side of a leveraged banking system with a small pooled backstop. If you run a business, your ability to make payroll rests on the same structure. You cannot opt out of the consequences by believing the logo harder. You can only decide whether you understand what it actually guarantees. This is episode 3 of the How the Dollar Actually Works trilogy, Episode 1, The Fed Debt Paradox, showed how the issuer of the currency can never run out of its own money, but can run out of political room. Episode 2, The Cantillon Effect, showed who gets fed first when new money enters the system. This episode showed what happens when the promise sitting on top of that system runs into arithmetic. Most people will only think about deposit insurance the week after a bank fails. You've now seen how it works before that moment. You can't control when the next crisis hits. You can control whether you walk into it thinking FDIC insured means absolute safety, or understanding that it means protected until the math and politics collide. If you want the full operating picture instead of headlines, watch the other 2 episodes in this trilogy and subscribe. The Foundation series on how past empires lost their money and what that pattern implies for the dollar comes next.